13, all about the analysis of financial statements. Okay, now, it'll be a little bit different from our previous classes. In our previous classes, we always talked about financial accounting. In this class, we're going to be focusing on managerial accounting. Okay, so again, managerial accounting will be a little bit different. Focus more about making decisions, how we're going to use accounting, how to manage our day-to-day business. Yeah, now the first thing we talk about, before we, say how we're going to use this information, the first thing we look at is probably the big thing here. Analyze financial statements. Remember, the financial statements are talking to us. Now, what are they saying? That's what we're talking about here. It says, okay, how is this going to work? What is it talking to us about? And what do we do? Why do we need to analyze statements? Probably about, why do we do this? First of all, what's it saying to us? First of all, reduce uncertainty. It says, okay, a little less, we're a little more confident, a little more accurate in our decisions, feel more justified every time we make a decision. That's very important here. Analytical tool. We're always comparing. How do we do from last year to this year? Again, transform the data. It says, all right, we have X amount of revenue. Now, how's it going to work? What's happening with our expenses? If I say it out again, it helps everyone. Again, the whole point is it helps us make the big thing right here. Helps make people better decisions. If you're within a company, that's fine. So if you're trying to, like, say you're an employee, you're a manager, that's fine too. Or you're external. Should you invest? Should you provide these people supplies? Are you a lender, shareholder? And again, look at different things here. How liquid is the company? Are they even liquid? Can they even pay their daily bills, monthly bills? Are you even being efficient? You have X amount of dollars. Are you using it wisely? Solvency refers more about long term. What are the long term potentials of the company? Will they still be here 5 years from now, 10 years from now? And profitability, not just, remember, you can't just make a profit. Did you reach your profit goals? What was in your goal? What was in your budget? Okay, and the last one we look at is your market prospects. Market prospects says, okay, based on the market you're in, how are you doing with it? Are you doing well? Are you not doing well? The current market that you're in. Again, information, I'm sure you all remember this from Accounting 211, talks about certain things. Obviously your income statement, balance sheet, all of our financial statements. All the statements we had created, in 211. Now remember, we can't just say, okay, the big thing is we're going to be doing a lot of, comparability. Okay, that's the standards. Comparison, you got to have something to compare it to. As we talk about right here, what are our comparisons? And again here, we compare it to many different things. We look at interpreted results. It's essential. We can't just say, okay, how, when we analyze financial statements, you always look at, obviously the big thing here is, we look for is, comparison. First of all, intra-company. Compare within yourself. The big question, how did you do last year, this year? From year to year, month to month. Competitors, Coca-Cola, their main competitor is Pepsi. They always compare themselves to each other. Take a look at the fast food industry. McDonald's, Wendy's, Hardee's, Taco Bell, Chick-fil-A. They always compare themselves. What was in our industry? The industry says, right off the bat there. So, okay, industry says, okay, based on the industry you're in, like talking about, we're talking about McDonald's and Chick-fil-A. They're in the fast food market. That's their industry. Now, guidelines could be, okay, where should we be? Even within yourself, say, okay, based on our size, based on how many employees we have, where should we be? And again, look at different tools for analysis. Now, horizontal, we're going to look at, you're going across the horizon. It means over time, over the year, over the month, the quarter. Vertical, we'll look at that too. It says based on a base amount here. And last one, ratio, again, compare between key, financial statement items. Horizontal, like I said, we look things across time. So it's okay, how are we doing from month to month, year to year? It can be day to day if you like. Again, the big thing we look for, okay, when we're analyzing the base period, did we have an increase or decrease? Analysis period says the current year, or the base period is the prior year. Now, you not only look at the amount you changed by, what was the percentage? Did you have an increase? Did you decrease? A lot of time it might be a goal. Well, I want sales to go up 5%. Or the opposite, I want expenses to be decreased by 10%. And so here the comparative balance sheet, for example. To look at our top figure. Now, cash here says went up by this amount, and now the percentage increase. You remember, the big thing is we're going to be doing a lot of horizontal comparing. Here they went year to year from 2014 to 15. Okay, cash went up. And you can come down the line. Says, okay, overall, how much our assets go up by? What was the percentage? Look at each account here. Same with the income statement. Says, okay, our sales went up 28% here. We round up. And if it's good or bad, the answer is always going to be it depends. What was your goal? What was your target? And back to market prospects, competition. So overall, I see, okay, how do we do overall here? Say, well, sales went up. Expenses also went up. Our net income, the good part is net income also went up, which is a good thing. But again, evaluate it. Look at it. It's talking to us. Look for trend analysis. Look at any patterns. Again, the base year. This year, our base year will be 2011. 2011. Compared to 12, 11 to 13, 14, and so on. Again, if you want to construct a graph, that's fine too. Again, example 1, our need to know. Again, any percents here. Now, verticals would be what's our base amount going to be? Balance sheets always going to be total assets. Income statements going to be our revenues. Okay, and again here, if you notice here, everything here is divided by our assets. So it's a percentage. It's okay, how much cash, of all of our assets, how much is cash? How much is securities and so on? And again here, what makes it up here? This one, everything's divided by sales. Give an example, cost of sales divided by sales. That means we'll just round up 60% of our sales got eaten up by cost of sales, cost of goods sold. And keep coming down the line. Graphs. Again, here's example 1. Again, ratio analysis now, the big thing, ratio analysis. The 4 building blocks we talked about earlier. Again, these are all going to be different ratios we look at. Liquidity efficiency is very important because it says, do you have enough cash to survive? Can you pay your bills? Can you pay your monthly debt? How are your daily operations? How are you, being efficient? And working capital. Obviously, you want a strong liquidity because, again, the whole main objective is to meet your current obligations. So again, your current assets minus current liabilities. Current ratio means for every dollar of current liabilities, how much current assets do you have? Can you even cover it? So, of course, you want this one to be high, at least above 1. Asset test is you want your most liquid ratio. So that's why if you notice here, it excludes inventory and prepaid expenses. Turnover. Again, look at our different ones here. How many times you convert all your receivables to cash? Again, it could be for the month, for the year, even for the quarter. It's good to make sales on credit. It's not a bad thing. But in the meantime, can you, convert it? Here it says, okay, how many times do we convert all receivables to cash? The inventory. How many times a year is it all sold and replaced? Because again, you buy inventory, but the goal is you want it obviously to be turned over. You want to be sold. And here, how frequently do you collect your receivables? Obviously, you want someone to be high too. You want to collect it often because that means obviously you're doing well. You're operating efficiently. Again, here it gives you a rough estimate. How many long does it take to sell inventory? This number you want to be small. Remember, you want things sold quickly. Asset turnover. Reflect on it again. You buy all these big assets. Can you even generate any sales for it? How efficient are you being here? Next, we look for a solvency. Obviously, debt and equity. So, okay, of all your liabilities and equity, how much is debt? How much is equity? Okay, of course, you want the debt to be low. That could be higher, but in the meantime, you got to look at these certain things here. Does the company have too much debt? What portion? Again, you might get some loans here. Measure how provide protection to long-term creditors. Can you even pay back all your interest? How many times can you? Yeah, profitability right off the bat here. Are you even being profitability? Are you even earning? Are you losing? Again, net income for each sales dollars. Okay, are you even getting any net income based on your sales dollars? What percentage of all your sales are you able to keep? The return. How well the asset has been employed? Are you using it well? You buy all these assets. Okay, is it bringing you net income? Maybe you're losing. If you have investors, you gotta make well. You gotta ensure they're getting back a return. If they're not getting back a return, they're not gonna invest any more money, and they might sell their investment. And the market. How are you doing the current market that you're in? Again, gauge here the stock value. Obviously, you want this higher. More opportunity for growth. Our company's goal is they want to grow. They want to get stronger. And again, market price. Are you even getting a dividend back on your stock? Yeah, this is actually a real good slide right here. You want to make sure you understand the summary of the ratios. Here are all the ratios right here. Make sure you understand them. Make sure I didn't know how to use them. And again, example 1. Again, analysis important. Again, the main thing is with the analysis, you want to look for certain things here. Reduce uncertainty in business decision. That's the whole point. You want more assurance every time you make a decision. Again, income statement here. Look at different items here. Okay, any questions? All right, class. That one's doing well, okay? Thank you.